Hey everyone, Alphabet is scheduled to report second quarter fiscal year 2024 results on Tuesday, July 23rd after the markets close. So in this video, I'm going to preview what investors can expect from Alphabet when they report financial results. I'm also going to answer whether or not investors should buy Alphabet stock before earnings or after earnings, or whether or not they should buy the stock at all. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So let's start with what investors should expect from Alphabet in its upcoming earnings release. So in the previous earnings release, management said that their leadership in AI research and infrastructure and their global product footprint position us well for the next wave of AI innovation. And Alphabet has been investing aggressively in building its AI data center and AI capabilities to serve customers that want to enhance their businesses using artificial intelligence. What's more, the company accelerated revenue growth in the recent quarter. You'll notice here that the change in year-over-year revenues, they grew just 3% in the same quarter the prior year in 2023, and that revenue growth accelerated by 15% in the quarter that ended March 31st, up to $80.539 billion. More impressively, Alphabet did this while increasing their profit and their profit margin. Operating income jumped from $17.415 billion up to $25.472 billion. The operating margin increased from 25% to 32%. And investors can reasonably expect Alphabet's revenue to continue growing and their operating profit to expand. One reason for that is because in 2023, they initiated massive cost-cutting programs, cutting thousands of jobs, tens of thousands of jobs, and now they're benefiting as a result of those cost-cutting initiatives. So I highlighted Alphabet's cost-cutting initiatives. You'll notice here they had 190,000 employees as of the quarter ended March 31st in 2023, and the same quarter this year, they only had 180,000 employees. So 10,000 fewer employees year over year, but despite the 10,000 fewer employees, revenue jumped by 15% and profitability jumped as well. So the lower amount of employees didn't hurt the company's revenue generating capabilities. There was a lot of waste built up in Alphabet's business. The company had been growing so profitably for more than 2 decades, they didn't really feel the need to do this kind of restructuring in any time in their past. And so now, after all those years, they finally undertook a productivity and efficiency improving campaign, and it was long overdue, and now they're going to benefit as a result. Another thing I wanted to highlight is Google search revenue jumped from $40.3 billion up to $46.156 billion. So there was a lot of concern from investors about how Alphabet would respond or how their business would be affected because of the rise of ChatGPT, because of the rise of large language models, because so many search queries are moving to ChatGPT instead of in Google search. But as you can see, we're not yet seeing the negative impact on Google search business. $46.1 billion, up from $40 billion in the same quarter the prior year. Now, that doesn't mean it's never going to happen. That risk is still present, but so far, after a year and a half of ChatGPT's existence, they haven't really taken Google search, and they haven't really taken big chunks of revenue away from Google search. So people are still searching in Google, and then ChatGPT is for a different set of use cases. A lot of different types of use cases are going to ChatGPT, but Google is still maintaining its search prowess. I've been talking about how much cash flow Alphabet's business has been generating over the last several years, how lucrative the business model is. And one thing I've been wanting Alphabet to do more of is share buybacks and returning capital to investors. They did initiate a dividend in their most recent quarter. They also increased their share buybacks, authorizing $70 billion of stock repurchase authorization. What I want to see in this upcoming earnings release is that they indeed used some of that authorization to repurchase shares. And I want to see a continued focus on capital return to investors. The company has a lot of cash. They're sitting on a lot of cash. And lately, they've been putting it to work more so than at any time in the last 5 to 10 years, especially with these developments in artificial intelligence. Alphabet is really investing in their data centers to build out their capabilities. And so they're using billions of dollars for that. And then they're also returning capital to shareholders. So I like that they're becoming more effective in the use of their capital and not just letting it sit in the bank account, right? We're not paying Alphabet's management team to take money that they generate and leave it in the bank account. We can all do that ourselves. We don't need to pay the big bucks to Apple's or Alphabet's management team, I should say, to hoard capital, right? We can do that ourselves. So either use this cash that you're generating from the business, reinvest in the business if you see opportunities to reinvest. If you don't see opportunities to reinvest, then return that capital to shareholders through these dividends, through these repurchases. So I've liked that they've been doing this lately. So speaking of its balance sheet, Alphabet had $108 billion of cash and equivalents and marketable securities, right? That's a lot of capital, and they only have $13.2 billion in long-term debt. Furthermore, this business is so profitable that holding on to over $100 billion in cash is a little much. So I like that they're returning this capital to shareholders. They can be a more efficient business with fewer assets. Their return on assets will be better if they return some of these cash hoards to investors. I also like that they're investing in their property and equipment. For Alphabet, this is primarily data centers. That's rising from $134 billion in property and equipment up to $143 billion. They've also told us they're going to continue adding billions and billions of dollars of new AI data centers. And so that's good news. They're investing right in the category that's growing the most right now. Artificial intelligence is the area most in need for many, many businesses worldwide. So Alphabet stock is already up 33% year to date. I'm happy about that. I own Alphabet stock. I've also recommended Alphabet as my top stock to buy in 2024. So I'm happy for both of those reasons. Now, to answer whether or not you should buy before or after earnings, Alphabet stock is trading at a forward price to earnings of 21.84, which I think is still undervalued. So I like the return versus risk for Alphabet stock investors. Now, whether or not you should buy before or after earnings, this is a situation where I feel neutral on each side. I don't feel that one side over the other carries more risk, whether you're missing out by not buying before earnings or whether you're risking a big drawdown by buying ahead of earnings. I think the risks are equally weighted on the front and back end of this earnings release. So when I see this kind of situation, I typically advise to take whatever amount you're considering investing, cutting it in half and doing half before and half after. As for the stock itself, I still like it and I still rank it as my top rated stock, and it's on my, of course, portfolio of top 25 stocks to buy. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button and I'll see you again soon.